Everyone loves a good deal, right? Especially when it comes to investing. The idea of free or zero-fee funds sounds like an absolute financial nirvana, promising unburdened portfolio growth. Fidelity, a name synonymous with affordability and accessibility, even offers zero-fee index funds, naturally tantalizing countless investors. This powerful marketing, coupled with Fidelity's sterling reputation, makes these offerings incredibly appealing. But what if I told you that some of the most seemingly attractive, even promisingly free index funds from Fidelity might actually be some of the most useless? This isn't about them consistently underperforming the market or being poorly managed. It's far more subtle and far more critical for the long-term investor. It's about a different kind of cost, a cost that isn't immediately apparent on a glossy fact sheet, demanding a deeper look beyond the surface appeal and initial excitement. For decades, Fidelity has cemented its formidable reputation as a leader in financial services, celebrated for expansive investment offerings and, crucially, unwavering commitment to low-cost solutions. When discerning investors seek smart, accessible, and efficient ways to grow wealth, Fidelity often springs to mind, particularly regarding their well-regarded index funds, and for profoundly good reason. Index funds, in their purest form, are financial marvels. They offer instant, broad diversification, spreading investment across hundreds, sometimes thousands, of companies within a specific market segment. This inherent breadth significantly reduces idiosyncratic risk, the danger of a single company's poor performance. Their passive management approach, simply tracking a predetermined market index, translates directly into substantially lower operating costs. These savings are diligently passed on to you, the diligent investor, as commendably lower expense ratios. This hands-off, systematic strategy means fewer management fees, less overhead, and ultimately a much larger portion of your hard-earned money remains actively working for you. For most prudent, long-term investors, the fundamental wisdom of index fund investing, buying the market, paying minimal fees, and allowing compounding to work its magic, is almost universally accepted and championed by financial titans like Warren Buffett. They truly embody financial prudence, offering a remarkably straightforward and highly effective path to wealth accumulation without the inherent complexities or elevated costs typically associated with actively managed alternatives. This robust foundation of low-cost, broadly diversified, and passively managed investing is precisely what makes them so profoundly powerful and popular. Given this glowing endorsement, suggesting certain Fidelity index funds are useless might sound sacrilegious. You're likely wondering, how can a low-cost, diversified fund from Fidelity be anything but beneficial? Prepare for a paradigm shift. The uselessness we explore today isn't about underperformance. That's too simple. The core issue isn't their investment performance in isolation, but a more nuanced, insidious realm. The problem lies not just in what they do, but what they prevent you from achieving effectively long-term. This directly challenges the ingrained assumption that a lower expense ratio always means a better fund. While crucial, expense ratios aren't the sole determinant of a fund's true value or utility to your specific financial plan. This narrow focus can mislead. These funds, despite attractive headlines and rock-bottom expense ratios, sometimes zero, carry a different, less visible burden. This burden manifests as practical limitations, potential hidden or indirect costs, and structural impediments. These subtly, yet significantly, erode long-term returns and stifle financial flexibility. The issues rendering funds useless are multifaceted: structural design limitations restricting portfolio management across brokers or even within Fidelity itself. Potential tax implications, initially invisible, can significantly reduce net returns over years. Furthermore, portability concerns, the inability to easily move investments without triggering undesirable events, are critical. These aren't deficiencies in market tracking, but practical, logistical, and strategic drawbacks undermining the very diversification and cost efficiency you sought. So let's peel back the layers. In personal finance, free often comes with an unadvertised price tag. Some seemingly perfect Fidelity index funds might be perfect only for Fidelity, not necessarily for you. Let's delve into the specifics. At the forefront of this discussion are Fidelity's much-touted zero expense ratio funds, FZRO, Total Market Index, FNILX, Large Cap U.S. Index, FZIPX, Extended Market U.S. Index, and FZILZ, International Index. On the surface, what's not to love? Zero management fees sound like an investor's dream, promising to keep every penny of your returns working for you. They're relatively young, launched in 2018, and have quickly gained popularity for their enticing cost structure. FZRO aims to track the entire U.S. market. FNILX covers large-cap U.S. companies akin to the S&P 500. FZIPX fills the gap for mid- and small-cap U.S. stocks, and FZILZ gives exposure to international markets.
However, the devil, as they say, is in the details. The primary drawback of these zero funds is their proprietary nature. Unlike most exchange-traded funds or ETFs or traditional mutual funds, these aren't transferable. If you ever decide to move your investments from Fidelity to another brokerage, perhaps due to better features, a new financial advisor, or simply consolidating accounts, you can't just pack up your FZROX or FNILX. You'd be forced to sell them, triggering potential capital gains taxes, and then reinvest the proceeds into a comparable fund at your new institution. This non-portability significantly limits your brokerage flexibility, potentially complicates future consolidation efforts, and can even create headaches during estate planning for your beneficiaries. Imagine the friction if your heirs have to navigate selling these funds and incurring taxes rather than simply transferring them in kind. Before we continue, it's obvious you are getting value from this value-packed video. Why don't you kindly share and like the video to help other investors see this video? Also, tell us where you are watching from. This proprietary structure also creates a secondary, less obvious, but equally impactful issue for experienced investors: the inability to effectively utilize tax loss harvesting. Tax loss harvesting is a sophisticated strategy where you sell an investment at a loss to offset capital gains, reducing your tax bill. The IRS has a wash sale rule, which prevents you from buying a substantially identical security within 30 days before or after the sale. Because Fidelity Zero funds are unique to Fidelity and lack direct non-proprietary counterparts, it becomes incredibly difficult to sell FZROX at a loss and then immediately buy another non-substantially identical total market fund elsewhere to maintain your market exposure without violating the wash sale rule. You're essentially stuck. This also applies to their relatively short track record. Analyzing performance or finding suitable, not substantially identical alternatives for a quick repurchase is challenging with limited historical data. For a general investor, this lack of flexibility can outweigh the zero expense ratio. Consider alternatives like Fidelity's own FSKAX, FAIX, or FTIHX. While these have infinitesimally higher expense ratios, FSKAX and FAIHX are both around 0.015%, and FTIHX is about 0.06%. They offer crucial flexibility. They are not proprietary, meaning they can be transferred in kind to many other brokerages, or at the very least have clear publicly available counterparts like VTSAX or VOO that are easier to navigate for tax loss harvesting purposes. That fractional fee is a small price for significant peace of mind and strategic maneuvering. Beyond the zero funds, other useless funds for a passive, diversified investor lurk within Fidelity's vast offerings. Think about highly concentrated sector-specific funds like FSELX, Fidelity Select Semiconductors Portfolio, or even FSPTX, Fidelity Select Technology Portfolio. While enticing during boom times, these introduce immense concentration risk. For someone building a core portfolio, such funds often lead to unintended overlaps with broad market funds and require constant, active rebalancing, directly opposing a passive investment philosophy.
Similarly, purchasing both an S&P 500 fund and a total stock market fund within the same portfolio leads to significant duplication and skews your exposure unnecessarily. Always check the underlying holdings to avoid buying the same companies multiple times. Some older, higher-cost index funds also persist within Fidelity's ecosystem. Always opt for the lowest-cost option tracking your desired index, as even a tiny difference in expense ratio compounds significantly over decades. The seemingly insignificant details truly dictate your long-term success. Consider subscribing to our channel, like and share it with your friends, and comment the key thing you learned so far. So we've unpacked the nuances of Fidelity's so-called useless funds, not because they are inherently bad performers, but due to their structural limitations. Funds like FZROX, while appealing with their zero ER, can restrict your tax loss harvesting options and lock you into a single brokerage. Even FSKAX, a fine fund, presents portability hurdles compared to ETFs. The essence of our discussion isn't about shunning Fidelity, but about selecting optimal tools within or through their platform. Your long-term success hinges on building an agile, efficient portfolio that serves your evolving needs, not just a brokerage's immediate offerings. Now, let's define what truly empowers an optimal investment strategy. Beyond merely avoiding pitfalls, an optimized portfolio is built on genuinely low-cost, broadly diversified funds. Crucially, these should prioritize portability and tax efficiency. This is why ETFs are often superior. ETFs offer seamless transferability between brokerages without triggering taxable events and inherently provide better tax efficiency, especially in taxable accounts, due to their unique structure. When selecting, always scrutinize the expense ratio, but equally important, ensure the fund offers comprehensive market cap weighted exposure, covering the U.S., international, and bond markets. So what if you currently hold Fidelity-specific funds? No need for panic selling. If you own FZROX or FNILX in a taxable account, liquidating them immediately would trigger capital gains. Instead, strategically halt new contributions.
Redirect fresh capital into universally portable and tax-efficient ETFs. For U.S. total market exposure, consider Vanguard's VTI or iShares ITOT. If you hold FSKAX, FZILX, or FXNAX, particularly in tax-advantaged accounts like IRAs, you have more flexibility. Consider gradually migrating future contributions or even existing balances to comparable ETFs for their superior portability and tax loss harvesting potential. For international, VXUS is excellent. For bonds, look at BND or BNDX. To construct this resilient portfolio, embrace the three-fund approach using broadly diversified ETFs. Envision one ETF for the entire U.S. stock market, like VTI, another for the global international equity landscape, like VXUS, and a third for the total U.S. bond market, such as BND. This elegant structure delivers immense diversification, exceptionally low costs, and, critically, maximum flexibility. These ETFs are universal assets, moving effortlessly between brokerages. This isn't merely a convenience, it's a core component of future-proofing your finances, simplifying estate planning or future brokerage changes. Approach your portfolio review without fear of mistakes. Investing is a journey of continuous optimization, not a race to perfect a static plan. The goal isn't to ruthlessly sell everything, it's to strategically redirect new money and future contributions toward these more flexible, tax-efficient, and globally diversified ETF options. Every dollar allocated wisely from this point contributes exponentially to your long-term success. Understanding why portability and tax efficiency are paramount, even over a seemingly tiny expense ratio advantage, is the key. Over decades, the ability to harvest losses, avoid taxable events during transfers, and have your investments follow you can result in significant additional wealth and peace of mind. These seemingly insignificant details truly dictate your long-term financial freedom. So, take control. Review your portfolio today. Like this video if it empowered you.
Subscribe for more expert insights and hit that notification bell. Share your questions below. Let's build your optimized, resilient portfolio together.